All right, what's up, everybody? Welcome back to the channel. My name is Roy Dunia. I'm the co-founder and CEO of ChartAddicts. We're a personal coaching service and an education platform for traders worldwide. This is a new series that we're launching on the platform, that we're launching on our YouTube channel, which is called Fundamental Sundays. So one thing that we're seeing lacking in the industry is folks are not well versed in what's happening in the economy. Folks aren't well versed in what's happening fundamentally. And so what I'm going to try to do on this first call is to break down the entire layout of what's happening today. Inflation, recession, all of the fears that people are having across mainstream financial platforms. I want to be able to break down for you guys in a simple way. I want to show you how it affects the stock market. I want to show you how it affects crypto. I'm going to show you guys how it affects FX. And I'm going to be sharing with you some things that I'm doing in this recessionary cycle to protect myself financially and to put myself in an advantageous position. What are the biggest topics that are being discussed today? There's two words that you guys will constantly see throughout the rest of the year. The word inflation and the word recession. Inflation is the rise in price of goods and services in an economy. And there's different types of inflation. You can have consumer inflation, which is the goods and services that consumers normally buy, whether it's diapers, household goods, food, and things like that. Those things going up in price is usually pretty bad for the economy because consumers have to pay more. We have to pay more at the grocery store. That gives us less money left over to go invest, to go spend in other places. The other types of inflation are asset inflation, which is basically if you own anything that has value, whether it's a house, whether it's art, whether it's stocks, whether it's bonds, whether it's crypto, any investment that you guys can consider an asset, which is a plus on your balance sheet. Those will go up in price whenever there's an asset inflation cycle. And if you guys want this in writing, if you guys want this in more detail, I wrote a very good article on the ChartAddicts website. You guys can go to chartaddictsfx.com. And I wrote a full article about the recession, what's happening, and what to look out for. But let's go through some of the history real quick. In 2008, we had the global financial crisis, one of the worst financial disasters that's ever happened. And so in order to stop a global depression, the US government started something called the Tarp Program, T-A-R-P, which was the first money printing program from the Federal Reserve, which will basically buy assets from the Treasury and just give them cash. So if you guys don't know, the Treasury is like the piggy bank of the United States, and the Federal Reserve controls the monetary policy, which is the speed of money in the economy and the cost of borrowing that money, and the availability and supply of that money. So 2008, we started the money printing program. I believe we printed something like $1, maybe $2 trillion at most. And what we've seen from 2008 up until 2018 is the most robust and the highest growth period in American history, in American economic history. After 2018, we felt like there was an inflation crisis on the horizon. So the Fed began raising the cost of borrowing money in order to slow down the economy. When you slow down the economy, prices tend to come back down as well. So what they're doing is, or what they did in 2018 was they tried raising the interest rates and the markets crashed. Then the Federal Reserve said inflation's too high. We're going to have to continue to raise the interest rate and normalize monetary policy. So they did that again. When they did it the second time, the market crashed even worse. It became too bad for the economy. The Federal Reserve had to switch course. They ended up stepping in and saving the day again. And so instead of pumping money out of the economy and slowing down the whole show, they had to go back and put money in the economy just to save us from a recession. So the economy was very shaky in 2019. It was very shaky leading up to the pandemic. The pandemic was the straw that broke the camel's back. As soon as we went into the pandemic, we went into a full-scale recession. The Fed had to stop slowing down the economy. They had to stop tightening. What they ended up doing is printing they printed a historic amount of money, the most money that's ever been introduced into the market at one time. Almost $17 trillion was printed from the start of, well, not printed, but was introduced into the economy from the start of the pandemic in March 2020 up until the late stages of the pandemic in late 2021. 2022 is when the Fed shifted their pivot. They realized that putting $17 trillion into the economy was only ever going to hurt the economy. So this is the dilemma that we have today. The Fed has a choice, which is crash financial markets, stocks, crypto, bonds, everything else, crash financial assets in order to save the real economy, Or let prices keep going up, let single mothers and families and working class folks pay more at the grocery store until they get mad and end up wanting a change in the regime and the way that things go. I want to show you a few very important charts that I feel like everybody should know. Since you guys are traders, or if you're not a trader, hopefully you're learning a few things and getting on your way. But if you are a trader, you guys will understand what these charts mean by looking at an overall trend, and I'm just going to explain and narrate what we're looking at in terms of that trend. First things first, the DXY. So I explained a little bit about the dollar's value. I want to show you guys what's been happening. So 2018, this is when we had the inflation scare. The Federal Reserve started to pull money out of the economy, and we had a massive bullish push. In March of 2020, we had the pandemic crash. The Federal Reserve dropped interest rates from whatever they were sitting at all the way down to zero to make the cost of borrowing money free, which improved the amount of flow in the system, the amount of money in the system. So they were printing money and making it almost free to borrow, which stimulated the entire economy in the matter of a few months. So we had a very sharp recovery. So you guys can see in 2021, they printed a bunch of dollars, and so the value of the dollar goes down as there is an excess in supply in the market. And then in 2021, late 2021 in the summer, that's when the Federal Reserve shifted and started to hint at the fact that there is too much dollars in the system. They're going to have to start pulling some away. Now, through their aggressive policy, what we've seen today is a massive spike from the lows at 90 or 89 all the way up to now we're sitting at around 104, 105. So you guys can see, whenever the Fed shifts their monetary policy, so in 2018, when they thought inflation was high and they tried to slow down the economy, dollar went bullish. In the pandemic, when they overprinted, the dollar went bearish. In 2022, when they're shifting their policy to becoming more tight and to becoming more conservative, that's when the dollar is rising again. So when will the dollar crash? Everyone's asking. When the Fed starts printing again. That's something very important to watch out for. If you guys are trading USD JPY, USD CAD, and USD JPY has just been gunning in one direction, you'll be like, when is it going to retrace? I've been trying to catch the retracement. Not until the Fed starts printing money or drops the interest rate back to zero. That's your playbook. So then we go over to the USD. This is the actual dollar. This is not the DXY, which is the dollar versus a basket of other currencies. This is strictly just the monetary supply. So this is something called the M1 money supply. Global economists look at money in a few different ways. There's the M1 money supply, M2 money supply, and M3 money supply. And if you add all those together, you get the total supply of money in the markets, or the total supply of money in the economy. The M1 money supply is just literally the volume of currency held by the public. So how much cash are people holding in their accounts? Not the money that's in transit, not the money that you're waiting for 2 or 3 days to settle from the transactions, not stocks, bonds, cash equivalents, certificates of deposit, which usually have a different settlement date. We're just looking at the basic money supply, the currency that's held by the public. So this gray bar here represents the 2020 pandemic. So you can see that prior to the 2020 pandemic, we were sitting at about $4 trillion in the total M1 money supply. That's how much money, that's the volume of money that was held by the public at the time in 2020. Post-pandemic, we're sitting at close to $22 trillion. So that's about $17 trillion in a little bit under 2 years. So you have to look at this. This is 2010. From 2010 to 2020, we were sitting anywhere between $2 to $4 trillion in the economy. Once they introduced $17 trillion into the economy, there's no wonder why prices are going up so high. Everyone has more money. There's so much more money in the economy that people's perception of money has changed. So prices go up, suppliers start to charge more, producers charge more, and so consumers pay more. This is the NASDAQ 100. The gray bar again shows the 2020 pandemic, the single most historic financial instance that's ever happened in the history of the financial world. You can see that up until then, we've had a pretty consistent growth. We've still been going up on an uptrend. We're still making higher highs and higher lows. But after the pandemic, that's when we shot parabolic up to the sky. So the money printing that happened, you ask yourself, where did all that money go? Well, a bunch of it ended up in the stock market, specifically in speculative tech stocks, such as Tesla, Amazon, Google, Facebook, and the rest. So when you look at this and you realize, all right, there's been a pretty clear shift and a pretty clear correlation. When the money gets printed, stocks go up. Now, in January of this year, when they stopped printing the money, they haven't stopped printing the money. Money printing has been reducing this entire year. And starting this week on Wednesday, today is June 12th, it's Sunday, June 12th. Starting this week on Wednesday, the Fed will begin to pull out $100 billion of liquidity out of the markets every month. The effect, we're going to crash financial markets, we're going to crash stock markets, we're going to crash crypto markets. And then later in the year, once the Fed can't take the drawdown anymore, they will begin printing again, and we can see a recovery in all of these different assets. What I want to show you guys here is the Bitcoin versus the Fed balance sheet and the ECB balance sheet. So you guys can see the red line is the Fed and the ECB balance sheet. These are the two largest central banks in the world. The red line shows the growth of their piggy bank over time. So you guys can see that as the balance sheet of these central banks has grown, the value of Bitcoin has also been keeping up in a pretty clear correlation. The Fed printing money is causing these assets to go up. If we look at Bitcoin going up 1-to-1 with the balance sheet. If we look at NASDAQ having an almost 0.9 correlation with the money supply, an almost perfect correlation with the money supply. We see the DXY having a perfect correlation with the Federal Reserve's decision making. 2018, they raised rates, the dollar went up. 2020, they dropped rates to zero, dollar went down. This year, they're raising rates again, the dollar is pushing to all-time highs. The recession this time around wasn't a US recession, it was led by the European economy. Their problems with Russia have seriously impacted their ability to trade with each other. The price of gas has gone through the roof, and inflation is at an all-time high in Europe, even worse than it is in the United States. So the recession is actually starting in Europe and making its way over here now, as opposed to the other way around, where it's a Wall Street-led problem that spreads all over the world. This time it's a European-led problem. The Russia crisis and the Russia war has led to a lot of supply chain crunches, especially in food, fertilizer, agriculture, oil, which is one of the biggest exporters, cars, because Germany's largest export is cars, but now that they're having issues exporting cars within the European Union and sending them out, there's been a decrease in the amount of cars available in the market. Supply chains through Europe have impacted the ability for China to send goods over to the rest of the world. China can obviously still ship things to the California ports, but getting through Europe and getting things out to that port on the Western European side, that's become a huge problem because Russia is just blocking the way. So what can we look forward to in this economy? If there's an escalation of crises from Russia, from China, or from any of our geopolitical partners, we can see a further decline in all the stock markets. We can see a further exacerbation of the recession, and then we can see the Fed tightening monetary policy even more. Now, if something breaks in the economy, when will the Fed stop this charade? It's when something breaks. If we go into a deep recession that we did not expect, if the dollar's value gets way too high and we can't trade with other countries, if we go into a deep war with Russia, not just an escalation, but where we have to send troops. If there's an escalation in the recession that turns into an employment crisis, that turns into a growth problem, we go into a depression. Any of those things breaking in the economy will lead the Fed to backtrack on their decision and to start pumping money into the economy. So they're going to keep tightening until something breaks. Once something breaks, they're going to have to loosen up. And once they loosen up, we will see a V-shaped recovery. So ladies and gentlemen, that is how I'm looking at trading this current market cycle. I personally believe that if you are aware of all these different elements that are happening, you can take advantage. If you know that people are hoarding dollars or institutions are hoarding dollars for the purpose of investing in the dip, maybe you should do the same. If you see institutions are about to load up on a certain asset class, maybe you should do the same. If you find yourself not knowing what to do, maybe you can join ChartAddicts and come understand how to use the fundamentals to your best advantage. So it's great to see you guys. Again, my name is Roy Dunia, co-founder and CEO. We will be keeping you guys updated every single week based on what's happening. This Recession Watch, this Fundamentals Corner series is now going to be the Recession Watch series. After the recession is over, we'll continue the Fundamentals Corner by just providing overall news. So I hope to see you guys here every single week. Keep an eye out for our podcasts, educational videos, and these fundamental videos. Again, my name is Roy Dunia, co-founder and CEO of ChartAddicts. Great to see you guys on this call. Take it easy.